All right, let's talk about one of the toughest, most confusing decisions any investor has to make. How in the world do you pick an investment fund? We're going to cut through all the noise and get right to the timeless, battle-tested advice from the legend himself, Benjamin Graham.
You know, I love this old joke. It just perfectly nails our theme today. Because in investing, it's not enough to just know the numbers on a spreadsheet. You have to really know what you own. Otherwise, you might look up one day and find your whole flock has disappeared. And that really gets to the heart of the problem for all of us today. We're facing what Graham called a bewildering variety of choices. I mean, it's a total ocean of options out there, and it's so easy to feel completely lost before you even start. To give you an idea of just how big this ocean is, look at this number. Back in 2002, this was how many mutual funds there were just in the US, and they were holding over $6.5 trillion. And believe me, that number has only exploded since then. The problem has gotten even bigger. So, that's the million-dollar question, isn't it? With thousands upon thousands of funds, how are you supposed to pick a winner? Well, most people just fall back on one simple, really tempting strategy, which, as we're about to see, is a massive mistake. And this brings us to what we call the performance trap. This is the #1 mistake that trips up millions of investors. It's the habit of chasing funds that have just had an amazing run. And you can totally see why this is so seductive, right? It just feels right. In pretty much every other part of life, a great track record predicts future success. You know, a great surgeon is probably going to do a great job on your next surgery. But the financial markets, they're a completely different beast. Past performance is famously not a guarantee of future results. Okay, now just look at this. This is absolutely wild. These were the rock stars of 1999. I mean, look at those returns. 291% in a single year. It is no surprise that billions of dollars from regular people poured into these funds. I mean, who wouldn't want a piece of that action? But here comes the brutal reality check. Let's say you put $10,000 into one of the hottest funds on that list. Well, just 3 years later, your investment would have been worth this. $829. That's a catastrophic loss of over 90%. It's a painful lesson in the dangers of chasing yesterday's winners. So yeah, let's not mince words here. As the commentary in the book puts it, chasing performance is one of the single dumbest things you can possibly do as an investor. But the big question is why? Why does this happen so consistently? Let's break it down. We're going to look at the totally predictable life cycle of a hot fund. It turns out that those incredible returns are often, as the book says, as perishable as unrefrigerated fish. And there are some very specific reasons why. It's a tragic but super predictable pattern. First, these huge returns get all over the news. Then, a flood of cash pours in from investors like us. This leads to something the book calls asset elephantiasis. The fund gets so bloated with money, it just can't be nimble anymore. So, to protect their huge management fees, the managers stop taking risks. They start herding, just copying what everyone else is doing. And the result? The fund's amazing performance completely collapses. And if that wasn't bad enough, there's this massive hidden headwind: costs. When you add up all the management fees and the cost from frequent trading, the typical fund starts the year 3.5% in the hole. It has to beat the market by that much just to break even. It's a huge disadvantage right from the start. Okay, enough about what not to do. Let's pivot. Let's talk about the solution. Forget all the hype and the traps. It's time to look at the intelligent way to actually pick a fund. This slide right here perfectly captures the huge difference in mindset. The typical investor is chasing things that are totally unpredictable, like past returns and media hype. The intelligent investor does the exact opposite. They focus on what they can predict and control, things like low fees, whether the managers invest their own money, and if they have a consistent strategy. So here are the 5 key signals you should be looking for. First, low expenses. That's a direct mathematical advantage for you. Second, you want managers who eat their own cooking. They have their own skin in the game. Third, look for a fund that dares to be different, not just a high-cost clone of the market. Fourth, a fund that's willing to close shows they put you before their own fees. And finally, a fund that doesn't shout about its returns shows humility. It shows they're focused on the long term. Or you could take the simplest route of all, the one that both Benjamin Graham and Warren Buffett recommend for most people, a simple, low-cost index fund. An index fund just buys and holds all the stocks in a market index, like the S&P 500. And because its costs are rock bottom, it has this almost unbeatable advantage over time. It's practically guaranteed to beat most investors in the long run. But here's the final twist. Even if you pick the absolute perfect fund, there's one more massive hurdle to get over. And the single biggest threat to your investment success isn't the market, it's the person you see in the mirror.
Yeah, it's a natural human trait called overconfidence. We are literally hardwired to believe we're better than average, better drivers, better at our jobs, you name it. And while that's great for your self-esteem, it is an absolute disaster when it comes to investing. It makes us think we can outsmart the market, time our trades perfectly, and pick the next hot stock.
And if you want to see just how irrational we can be, look at this. A survey asked people if they were in the top 1% of earners. 19% said yes. Almost 1 out of every 5 people thinks they're in the top 1%. That's just not how math works, and it shows you how deep our delusions can run. And here's the real-world cost of that kind of behavior. This number shows how much the average fund investor underperformed their own funds every single year. How is that even possible? Simple. They chased hot funds in, and then they panic sold them when they went down. They bought high and sold low, turning what could have been decent returns into personal losses. So after all this, after avoiding the traps, picking the right kind of fund, and recognizing our own worst habits, what does it all really come down to? What's the one single most vital trait you need to have? It's this: patience. It's not about being a genius or finding some secret formula. It's about having the discipline and the emotional temperament to stick with a solid plan through the good times and the bad. In the end, that is what truly separates the successful investor from everyone else.